And I'm delighted that we have a panel of great experts today who are going to shine the torch of enlightenment through the fog of tax announcements this year. We're going to start with my learned colleague Adele Clapp, who's a personal tax director, focusing on international tax and employment taxes. We're then going to be joined by the marvellous Len Dean, VAT partner, who's going to be talking us through indirect taxes. We've then got Mark Richdon, ever eloquent, who's going to talk us through changes to businesses. And finally, last but by no means least, we're going to be joined by Pippa Clarke, our esteemed chair, tax partner, who's going to be dealing with all the really tricky stuff. She's going to be talking us through some international tax changes which are aimed at the larger corporates and some of the changes that were announced yesterday in relation to energy producing companies. Okay, before we start our actual presentation, just to say, I'm sure you're going to have questions as we go along. You have got the function at the top of your screen. There's a Q&A. Please press the button, type in your questions. We're going to deal with them all at the end. If perchance by the end of everything we haven't dealt with your questions, I'd urge you to, as usual, contact your normal BF friends or anybody that's talking today. And of course, I urge you to have a look at the Bishop Fleming website, which contains a plethora of information, articles and films. Final thing to say is this is actually being recorded, so if you miss a little bit, don't worry, you can watch it back. You can invite friends and family around to have a little look. It will be going live in a couple of days. We'll be sending you a link. It'll be on YouTube, and I understand that there will be the ability to read a transcript. I say transcript, it is a form of transcript that YouTube makes available to us for anybody who has needs to see our webinar in a different way. I think that's it from me. So without further ado, I'd like to pass over to Adele. Thank you.
Thanks, Izzy. So Jeremy Hunt obviously started this announcement yesterday stating that the UK has the most generous personal allowances than any other G7 country, and he used this as a way to extend his policy of fiscal drag. So for anyone who doesn't know what that means, it's in effect they've frozen the allowances and thresholds until about April 2028. And this is despite the challenges facing households for the next 2 years with a drop in disposable income. So I'm just going to recap on what's actually happened, and just so everyone's aware of what changes have been introduced and what have been repealed in effect. So the income tax personal allowance is going to remain at £12,570, with the higher rate tax threshold remaining at £50,270. The national insurance primary threshold, which was increased to £12,570 in July, will also remain at this level until April 2028. The freezing of these allowances is actually going to impact average taxpayers much more than additional rate taxpayers, because additional rate taxpayers don't actually benefit from a personal allowance in the first place. So it's estimated that by 2027-28, the total number of income taxpayers is going to increase as a result of this freeze by 11.6 million, and the number of higher or additional rate taxpayers is actually going to increase by 1.7 million. So you can see how this is quite a stealthy tax in effect. The national insurance rate increase of 1.25%, which happened in April this year and was then repealed in November this year, isn't going to be added back in, so there's no further changes announced to national insurance. So we're still at the 12% and 2% national insurance rates for employees and 13.8% for employers. Just bear in mind that for the current year, Class 1A national insurance for benefits is actually at a weird 14.53%. Despite Rishi previously supporting a potential drop to 19% in the basic rate of income tax, there's been no announcements in respect of this, so it is going to stay at 20% for the foreseeable future. And just to illustrate the impact of the fiscal drag, if you just assume for a moment that wages grow by steady 3% over the next 5 years, someone on a salary of £35,000 now is going to be £75 worse off next year and £400 worse off in 2028-29. Compare this to someone who's on a salary of £50,000. They're actually going to be £321 worse off next year, and that's going to increase to £1,939 in 2028-29. So it is a big hit at a time when households have less spendable income. The other change is with respect to the additional rate threshold, which was conveniently reduced from 150,000 to 125,140. and this is going to drag another 350,000 taxpayers into that 45% tax rate. Conveniently, the reduction of the threshold to 125,140 actually perfectly preserves the 60% tax trap that taxpayers fall into when their income exceeds 100,000, and this is solely because of the clawback of the personal allowance. It's actually anticipated that over the next few years, over 1 million more workers are going to fall into that 60% tax band as a result of the freezing of those allowances. So again, it is a big tax hit. And just to give you an illustration, someone earning £150,000 next year is going to end up paying an additional £1,243 in income tax. Turning to self-employed taxpayers, the Class 2 and 3 thresholds remain frozen, and the rates will increase by inflation. So in effect, Class 2 becomes £3.45 per week, and Class 3 is payable at £17.45 per week. For business owners or small company owners, the increase of the dividend tax by 1.25% for the health and social care levy is here to stay, despite the 2-year delay in social care reform. So what you now need to think about is taking dividends is going to be more expensive. In addition, the dividend allowance will decrease from £2,000 to £1,000 in April 2023, and is then going to further decrease to £500 from April 2024. So the timing of taking dividends is going to be very important. You're also going to need to have a think about how you extract profits from your companies going forwards, and this is going to depend on a few things. Mark's going to touch on the corporate tax rates that might be payable going forwards, and you also have to think about what your own personal tax rate is going to be, but potentially business owners could be looking at a tax rate of over 50% when they extract profits from their own companies. Turning to capital taxes, although there was much speculation about rates of capital gains taxes increasing and potential wealth taxes, the only real change announced was to the CGT annual exemption, which is going to decrease from £12,300 to £6,000 in April 2023, and then further reduced to £3,000 in April 2024. This is more likely to have a significant impact on pensioners and investors. For inheritance tax, again, there was no real change. Pretty much, we still got the nil rate band at 325,000, which has been at that level since April 2009. Because of increase in property prices, we are getting more taxpayers who are going to be subject to inheritance tax when they die. But we do have a residential nil rate band, which also is unchanged at £175,000. For pensioners, it's not all bad news, although it might be for those of us under state pension age, with the fact they're announcing that there's going to be a review into this in 2023. So pensioners are protected from inflation with a confirmed commitment to the triple lock and pension credit increasing with inflation. Just turning to a few points for employers. Individuals aged 23 and over earning the national living wage are going to have a good pay rise at 9.7% increase, so they're going to be getting £10.42 an hour from April 2023. It's likely that the low pay commission's other recommendations for national living wage will also be accepted, so it's anticipated it will be a 9.7% increase across the board, except for 21 to 22-year-olds, where it's anticipated that it will be a 10.9% increase. The employer national insurance threshold is going to remain at £9,100, although the employment allowance increase of £5,000 is going to remain in place until March 2026, which will reduce the impact of that freeze. And it wouldn't be a webinar with me if I didn't mention the off-payroll worker rules. So these were repealed earlier this year, which everyone got very super excited about, and then it was cancelled. So in effect, the rules remain in force with absolutely no change, and there was no mention of a future change or review into the rules. I do wonder whether this is because of the change in the definition of small businesses, which was introduced in October of this year. So in effect, businesses are classed as small if they meet two of the following: if they have an annual turnover of 10.2 million or less, they have 5.1 million or less on the balance sheet, and have 50 or fewer employees. Liz Truss increased the employee threshold to 500. but it only applies to new regulations which are under development and any other regulations which are under current or future review. And I do wonder whether that's why they haven't mentioned a review into the off-payroll worker rules, despite damning reports that was carried out and published this year, which stated pretty much that it's difficult for businesses to get the right information to apply the rules properly. They weren't happy with the fact that there's no independent review process, the fact that the HMRC's check employment status indicator tool is very difficult to interpret, and there's no clear definition of self-employment. It also stated that in 2020-21, central government themselves didn't correctly apply the rules and actually owed £263 million in back taxes. Interestingly as well, the promised employment bill, which was announced in 2019, has failed to materialise. It is currently with the House of Commons for its second reading, and there is an amended definition of worker in that. So let's see what happens when that is legislated. And as a final point, before I hand back to Isobel, any company looking to bring in electric cars for company car benefit purposes, there is now greater certainty. So from April 2025 to 2026, we know that car benefit percentages will increase by 1% for the following 3 years, up to a maximum of 5% for electric cars and 21% for ultra-low emission cars. Rates for all other vehicles will increase by 1% from April 2025, up to a maximum of 37%, and will then be fixed for the next 2 years. And over to Izzy again.
Thanks very much, Adele. That's very interesting. So I think what the Chancellor was saying yesterday, that we're all going to be paying more taxes, is very much true. We're all sharing the pain, but it feels like it's coming in a little bit slowly and steadily, and maybe we won't see it quite as much as the general cost of living rises. So without further ado, I'd like to pass over to Len. Tell us what's been happening in indirect taxes.
Well, hello, yeah, thank you. Well, actually, despite all the fiscal event excitement we've had this year, it's been actually a bit of a fallow year for us VAT advisors, with not a lot of big announcements. And it seems like the exciting VAT budgets, like the pasty tax one, seem to be a long time ago. However, I think there are some important indirect tax announcements in the autumn statement. So I will cover those off. And I'll continue on the topic of cars that Adele was on a minute ago. Quite a big announcement about vehicle excise duty, also known as road tax, and from 2025, electric vehicles will no longer be exempt from road tax or the additional expensive car supplement. So hybrids will be road tax equalised as well. So what that means is that most will move to the standard rate of road tax of £165 a year. And then if you add in the expensive car supplement, which is for cars with a list price over 40,000, and that's an extra £355 a year for 5 years. So a Tesla owner's road tax will go from £0 currently to £520 a year in 2025. So quite a big tax jump. Obviously, there are lower first-year road tax rates for new cars, but again, zero emission cars will still be taxed at £10 a year. Low emissions are going up to 20, and there are increases for electric motorbikes and electric vans as well. So that's probably quite a big revenue generator and quite a big change in tax policy on green vehicles. Another one, the announcement in the statement was about stamp duty land tax. So from the 1st of April 2025, the current extended 0% thresholds are going to be put back down to where they were before the stamp duty zero extensions that were announced and are currently effective and have been since the 23rd of September this year. So all that's been announced is that those zero rate thresholds are going to go down to 125,000 from their current mark of 250,000. And also the first time buyers 0% extensions are going to come down from 425 currently down to 300,000. And the maximum purchase price reliefs for first time buyers are also coming back down from 625,000 down to 500,000. So that's the announcement. Thinking about it, presumably it means that it's essentially a return to the stamp duty land tax thresholds that were in place before the 23rd of September this year. So that will bring back, I expect, the 2% band, which runs up to 250,000, the 5% band that goes up to 925,000, the 10% band to 1.5 million, and the 12% rate applicable to all amounts thereafter. So that is a quick reversal, but of an announcement only last month, but it's scheduled to come in on the 1st of April 2025. The only really thing that was mentioned and specifically mentioned in the Chancellor's speech on VAT was about the VAT registration threshold, and it was quite interesting because it was prefaced with the Chancellor noting that the UK's VAT registration threshold is one of the highest, I think he said, in the EU. It did used to be the highest, but it hasn't changed, and the others haven't changed. But we've been overtaken by Switzerland and their 100,000 Swiss francs threshold, but we've been overtaken because of foreign exchange rates and the weak pound. So we're now not the highest at the moment. Some other countries do have fairly high ones, like France and Ireland. Some of them are actually really low. So Germany and the Netherlands is only 22,000 euros. So a lot more small traders are within the scope of VAT in those countries. So when the Chancellor mentioned ours being very high, I was initially thinking, is this a preface to him announcing a big announcement of dropping the VAT registration threshold? But on reflection, I think it was to justify continuing to freeze the VAT registration threshold this year in particular, given the rate of inflation it's running at. Keeping that threshold still will still bring a lot more traders into the scope of VAT and VAT registration. But the threshold itself hasn't changed since 2017, whereas before that it used to change a little bit every year. So it's not a new policy, but I think it's the context of inflation that makes it more important. Also, quite well, surprisingly or not, but the word Brexit wasn't mentioned at all in the Chancellor's statement. And there wasn't very much in the context of what Brexit means from a sort of indirect tax point of view, other than the announcement of a 2-year suspension of import tariffs on over 100 products. That's all we've got at the moment. But he specifically mentioned products ranging from bike frames to food ingredients. And the rates involved range from low percentages up to 18% being suspended for 2 years. And his words were following applications from business stakeholders. So I think that means that it's specific import duty tariffs that were like causing problems or were really hampering growth and trade in those specific areas in the UK. So they are being suspended for a 2-year period. And we'll have to see the detail of what comes out in due course of which specific ones they are. And then just to give a bit of a general update on sort of other VAT news, although the budget notes announce an investment of 79 million in HMRC staffing, it says it's focused on tackling tax fraud. But I was keeping a keen eye on that because I think there's several departments, VAT departments in HMRC that are really struggling and need some resource to deal with a huge backlog. I'm sure a lot of you are experiencing similar problems with delays with HMRC on VAT, processing standard applications, VAT registrations very slow, options to tax very slow, VAT grouping really slow and problematic for people with dealing with VAT groups and not hearing back from HMRC. We're also seeing a lot of disconnected issues with VAT applications. So you put in a VAT registration with an options tax and one gets rejected and one gets approved. It's a bit nonsensical, but also they're very slow on error corrections, and we're seeing even large amounts are due back to HMRC. They're sitting on it for a long time, and that just means they're missing out on tax as the older periods fall out of time. Also, there's issues come out of that on delays where they're issuing assessments, and there's set rules about if they don't do it within a year of being given the information, then they're restricted on how much they can actually assess. So keep an eye out on that, because these delays could lead to invalid assessments from HMRC, or if they owe you money, interest due on the amount they owe you. And just to end on a positive note though, on VAT and HMRC processes, just very recently the online error correction form the dreaded VAT 652, which used to be one of the most tortuous experiences, particularly for VAT advisors filling out millions of boxes, has been made quite a bit less tortuous. So that's one positive that's beneficial for me and my team anyway, and I guess for a lot of you guys out there. So that's it on indirect taxes, and I'll hand you back to Isobel.
Thanks very much, Len. Now, I know you did try and move us onto a sort of positive slant, but I need to come back to HMRC because I need to join in on the rant there. So yes, they've announced another 79 million going in to tackle serious fraud and compliance with higher net worth individuals. We know earlier in the year, I think they announced extra funding to go in to tackle fraud in the R&D unit. And really, actually, I think all everybody's calling out for, that's agents, taxpayers, Chartered Institute of Tax, Institute of Chartered Accountants, England and Wales, is investment into the very basics. We just need people to answer the phone. We need people that can allocate payments to the right person to the right year. We need people to actually open Post, because we find out that Post isn't being dealt with for 6 to 12 months. We're on an absolute hiding to nothing to actually get anything resolved. Clearances are a whole new ball game, so that's not necessarily where they've got a statutory deadline. We sometimes find that they're meeting that. But we have a whole new set of issues there with a massive amount of inconsistency in terms of the responses, the type of things that are getting turned down, and some really nonsensical arguments being put forward, nonsensical questions and arguments being put forward in inquiries. I don't know quite who's dealing with correspondence there, but really there just needs to be some proper grassroots investment in HMRC. Forget about tackling fraud. Let's just look after taxpayers. Anyway, I'm stopping my rant now. Thank you very much for listening. That helped a lot. And I'd like to pass over to Mark Richdon.
Thanks, Isobel. This was the difficult decisions autumn statement, according to Jeremy Hunt. But the most difficult decisions seem to be in what he didn't say yesterday. With the mini budget just 2 months ago and the subsequent U-turns, I'm going to just spend a few minutes talking about some of the changes that will be affecting companies in the near future. Now, following the corporation tax rate over the last couple of years has been a bit like watching an episode of Play Your Cards Right. I'm not going to do a Bruce Forsyth impression, but you can play along at home. So when Rishi delivered his pre-COVID March 2020 budget, the corporation tax rate was 19%. He then proposed it to be lowered to 17%, then increased to 25%, then to 19% in the mini budget, which was U-turned back to 25%. So where are we now? Well, you don't get anything for a pair. From April 2023, the corporation tax rate will be, as previously announced, 25%. This will be the first time the rate has increased since 1974, and at the same time there will be the reintroduction of the small profits rate previously enforced in 2015, along with marginal relief. So from April 2023, companies with annual taxable profits of £50,000 or less will be subject to the new small profits tax rate of 19%. Companies with taxable profits in excess of £250,000 will be subject to the main corporation tax rate of 25%, and companies with profits between companies with profits between 50 and 250 grand will pay at 25% less marginal relief, meaning the effective marginal tax rate in that band is actually 26.5%. The last time a corporation tax return included marginal relief, the thresholds were reduced by being divided by the number of associated companies. From April 2015, when marginal relief no longer applied, the rules changed to a significantly simpler system of looking only at 51% owned group companies. This is especially important when determining whether a company is large or very large for quarterly instalment payments. With the reintroduction of marginal relief, the associated company definition is back. This can have wider and more immediate implications for corporation tax, because if your accounting period ends after April 2023, a potentially higher number of companies are to be included in that calculation. Companies previously outside the requirement to pay under the large or very large quarterly instalment regime could now have to pay their corporation tax earlier than anticipated. And although group taxable profits may be below 250 grand, depending on how many associated companies exist and which company generated the taxable profits, it's possible the main 25% tax rate could still apply. As Adele mentioned earlier, another of the tax rates that yo-yoed as a result of the mini budget and subsequent U-turn was the dividend tax rate. Now, why does that impact companies? Well, if a company has an outstanding loan to a participator, it will incur what is known as a Section 455 tax charge on the value of that loan at the year end. The tax is repaid when the loan is repaid, so it's purely a cash flow timing difference, but the Section 455 tax rate is in line with the higher dividend tax rate. As the dividend tax rates have increased from last April, Section 455 has also increased, and that could lead to unnecessary cash flow issues if tax planning is not done around settling these loans within 9 months of the year end. Now, something that escaped being caught up in the mini budget was the temporary super deduction capital allowance relief. The relief allowed companies to claim 130% of the cost of new qualifying plant and machinery in the year of purchase against their taxable income, or 50% of the cost of new qualifying special rate assets such as integral features. Super deductions will end on the 31st of March 2023, and any year ends that straddle this date will have to apportion the 130 or 50% based on the number of days of their accounting period falling prior to the 1st of April. But what if the asset doesn't qualify for super deductions or is purchased after the 31st of March? Well, then it's important to consider the annual investment allowance. The annual investment allowance provides 100% relief for certain capital purchases up to £1 million a year. The definition of qualifying capital expenditure is more widely drawn compared to the super deduction, which means it's applicable to a higher proportion of business assets. Unlike a lot of what we're talking about today, this was a mini budget initiative that's being kept, and it's advantageous to businesses because having changed 6 times in the last 14 years, the annual limit of £1 million is permanent. What is changing is business rates. The government is going to go ahead with the revaluation of business properties from April 2023 to accurately reflect market values, but they will soften the blow in a number of ways. The transitional relief scheme will cap bill increases caused by changes in rateable values at the 2023 revaluation. The multiplier will be frozen in 2023-24 and increased to 75% business rates relief for eligible retail, hospitality and leisure businesses. And the supporting small business scheme will protect the smallest businesses losing eligibility for reliefs. The government is also refocusing their programme of investment zones to create high potential clusters, although announcements of these will be released in the coming months. Now back to changes from the mini budget. A key part of company growth can come from incentivising employees and specifically share schemes. HMRC have 4 tax-approved share schemes, and one of the most flexible and tax efficient is the Enterprise Management Incentive, or EMI, share scheme. Where a company doesn't meet the qualifying conditions for an EMI scheme due to, say, their size, they can sometimes still meet the criteria for a company share option plan or a CSOP. Historically, CSOPs are less flexible than an EMI scheme, but in the mini budget, the total maximum employee share option limit, based on the market value at the date of grant, is to increase to £60,000 from the 1st of April 2023. This isn't as high as the £250,000 through an EMI scheme, but it's bringing the two more closely aligned. In addition, there can be an inability to qualify for CSOP if the company had multiple classes of shares. However, HMRC are removing these rules to open up the scheme to a wider pool of companies as well. To finish, I'm going to talk through the changes announced regarding research and development. Already announced in the spring 2022 statement were a refocus of R&D relief on activity carried out in the UK, a new requirement to notify HMRC of the intention to make an R&D claim in advance of filing, and HMRC widening the scope of development activities to include cloud computing and advances in the field of pure mathematics. These are all applicable from the 1st of April 2023. Yesterday, the government also announced an increase in public funding for R&D to £20 billion by 2024-25. However, they are also reforming the relief, because they've identified significant error and fraud in the small and medium-sized enterprise SME scheme, with the generosity of the relief making it a particular target. Therefore, for expenditure on or after the 1st of April 2023, the SME additional deduction will decrease from 130% to 86%, and the SME tax credit rate will decrease from 14.5% to 10%. Ultimately, this reduces the benefit for a business surrendering for a payable tax credit from 33p in the pound to 19p. By contrast, the rate of research and development expenditure credit, which is abbreviated to RDEC, will increase from 13% to 20%. So this will increase the benefit from 11p in the pound to 15p and is seen as a step towards a simplified single RDEC-like scheme for everyone. Now back to Isobel.
Thanks very much for that, Mark. That was really interesting. I hope that's clarified everything for everybody there. There's an awful lot of content. And to finish off, I think I'd like to pass over to Pippa Clarke.
Thank you, Isobel. So I'm going to spend a little bit of time talking to you about some of the changes that apply for taxpayers that might be looking to avoid tax in the UK with some international planning. And then I'm going to finish with some of the changes that apply to electricity generation companies. The first thing I'm going to cover is in relation to non-domiciled UK tax resident individuals. So there are some quite prominent people who fall within this category and some quite wealthy people. One of those, of course, is the wife of our Prime Minister. And it was widely publicised, the arrangements where some of her non-UK income was not subject to tax in the UK. And what we have still is that regime applying. So if a non-domiciled UK resident individual has non-UK source income and gains, those are not subject to tax in the UK unless they bring them back into this country. What changed yesterday is that previously, if an individual in that situation had UK shares, which they then exchanged for non-UK shares, and that can be done without necessarily triggering a tax liability, those non-UK shares could then produce income and gains which would not be subject to tax here. So they were moving from an asset which produced an amount that was taxable here to an asset which produced an amount which was not. As of yesterday, that rule has been amended, so those new shares, which are foreign shares, not British shares, are now going to be treated as if they are a UK situs asset. So the income and gains that they produce will still be subject to tax here. So that will only apply to situations where the company in question is what's called a close company. So that would typically be one with few shareholders, perhaps an owner-managed business or a family investment company. It wouldn't necessarily apply to shares that are in a listed company, for instance. But where the individual is in a position to significantly influence what happens with the shares, and it's a close company, then these new rules will mean that they cannot any longer go through an exchange of shares to get around the UK tax that's due on the income and gains that they realise. So that's the first thing. The next thing I want to talk about is something that's a bit less publicised, and some of you may not be quite so familiar with, having heard some commentary in the press on these things. This is the UK's commitment to introduce the OECD Pillar 2 framework into UK domestic law. Effectively, this is a measure to counter international tax avoidance that OECD countries have agreed is a good thing. The intention behind the measure is to make sure that there's a global minimum corporate tax rate of 15%. Now, that can't be done by every country in the world or in the OECD aligning their tax systems. Each country has jurisdiction over its own tax system in terms of the reliefs that are available and the rates that are applicable. So it isn't applied in that way. What it relies on is OECD member countries introducing domestic anti-avoidance provisions in order to ensure that they have measures that mean that where there is less than 15% tax payable anywhere in the world, there's a top-up tax applicable somewhere in the world to bring it up to 15%. So the UK has said that we're going to be bringing this in for accounting periods beginning on or after the 31st of December 23. It only applies to corporate groups with a consolidated revenue of over 750 million euros, so really quite large groups of companies. And there will be two things that are introduced on the 31st of December 23. The first is an income inclusion rule. So if you have a UK headquartered business with overseas operations, which suffer less than 15% effective tax rate on the profits from those operations, the UK will charge an additional amount to bring that rate back up to 15%. So there'll be some UK tax due to the Treasury here. The other thing that's going to be introduced is something called a qualified domestic minimum top-up. This is if UK operations have an effective tax rate of less than 15%, and that might be by reason of particular reliefs and allowances, then there will be a top-up tax applied here to bring an additional amount here so that the effective rate comes up to 15%. The policy decision there, I think, is because otherwise an upstream offshore parent company jurisdiction could potentially charge that additional tax because the effective rate here would be less than 15. So that means that the tax comes into the UK instead of going into an offshore parent jurisdiction. As a backstop, there's a further measure that they're looking to potentially introduce, but this won't be introduced until accounting periods begin on or after the 31st of December 24, and that's something called the backstop undertaxed profit rule. And that's a measure which will deny deductions if necessary to ensure a 15% minimum tax, but we have a bit less detail on that. So these rules apply only to larger businesses. They're highly complex. The model rules from the OECD comprise 10 chapters with pages and pages of commentary, because they only apply to those very large business, the anticipation is that those organisations will have the capacity to address these complexities. The next thing I'm going to briefly touch on in relation to international anti-avoidance is something that already exists, and this is the diverted profits tax. At the moment, this applies a 25% tax rate on profits which are deemed to have been artificially diverted out of the UK to a related entity where that related entity lacks economic substance. There is a carve-out, so this isn't applicable to SMEs. That would be typically businesses with at least 250 employees, where turnover is either below 50 million euros or balance sheet is not at 43 million euros. So those SMEs wouldn't be affected by this. The rate is going to increase from 31% from April 23 when the corporation tax rate goes up. That therefore retains the 6% differential with our standard corporation tax. And in effect, what the measure does is it brings back into the UK profits which have been artificially diverted and subjects them to UK tax, but not just at our usual domestic rate, at an additional 6% rate as a bit of a penalty for having moved things out of the UK in the first place. So that's all I'm going to touch on international measures. Looking at some of the measures that have come in for electricity generation, I want particularly to talk about the new electricity generator levy. So this may be applicable to solar farm operators and other renewable generators, and that might be counterintuitive because these are businesses that are ostensibly producing energy in a much more environmentally friendly way and doing some good for the environment. So it is counterintuitive, but the argument is that these businesses are experiencing super profits at the moment. And that's because the price that they sell electricity at is really geared to the market price, which is heavily reliant on gas-powered electricity production. So they're able to benefit from those higher prices in the market without necessarily suffering the additional costs that gas-powered electricity producers are suffering. So where this applies is where you've got electricity generation in the UK, which is supplying either the national grid or some local distribution networks, and those distribution networks could be overseas as well. And it only applies, though, to businesses where they're generating over 100 gigawatt hours per annum. So there is a threshold. The tax rate is high. It's 45% on what are called exceptional generation receipts. Now, these are calculated as the receipts minus a benchmark price of £75 per megawatt hour minus 10 million. So you have to look at what is the electricity that's generated that's within the definition. Then you have to look at what are the receipts from that, and then you have to deduct the £75 per megawatt hour and the 10 million. So really only applicable to businesses with fairly significant revenues from electricity generation from renewable sources. It's coming into effect on the 1st of January, and they've said that it will expire on the 31st of March 28. Because it's a 45% levy, this is on top of the corporation tax rate of 25%. So it does mean that you've got an effective 70% rate on those revenues that come in over £75 per megawatt hour. So that is high, but the policy decision behind it is that these are super profits that would not have been experienced other than for things that are going on in the market that don't affect these businesses. We are told that HMRC and the Treasury will be discussing this with generators who are caught. We're not yet privy to what the legislation will look like. We haven't got any draft legislation, and HMRC and the Treasury are inviting those who are affected to contact them to discuss. So any of you who are affected by these measures, there is that invitation, and you do have an opportunity to discuss it with HMRC and the Treasury before it's introduced. So this is separate from and in addition to the existing energy profits levy, which is applicable to oil and gas companies, and that is being increased by 10% from 25% to 35%. So that's all I was going to say on the electricity generation market and international. So back to Isobel for questions.
Thank you very much, Pippa. And actually, thank you to all of the panel. That was marvellous, really, really illuminating. Thank you very much. Actually, I think it probably makes sense. We've had a few questions through, and the first one that I'm going to pick, given it follows straight on from you, Pippa, I think you've probably answered this, but if I can just refer back to it, the question was asking, the autumn statement includes a new 45% tax on companies generating electricity to apply from January 23. Can you confirm this does not include businesses that generate electricity for their own usage via solar panels?
That is certainly what we have been told in the commentary that has come out so far. This is intended to apply a levy to generators who are selling electricity and benefiting from the additional market price that they are able to get at the moment.
Okay, I thought that was the case. Thank you very much. There's another, it was less of a question, more of a comment from somebody out there saying they'd had a letter from HMRC to a response regarding a call made in October 2021. We're only a year late. Well done. Well done. I feel very proud of them. That did make me laugh. Thank you very much for that. We've got a question. Will working pensioners still have to pay NI contributions on their pay from next April? Adele, I suspect this might be one for you.
No, the health and social care levy's been abolished, or at least pushed back, so there won't be any additional national insurance payable by pensioners next year.
Thank you. Thank you. I think probably staying with you, Adele, actually, HMRC issued a discussion paper about extending CGT reliefs between divorcing spouses from April 2023. Are they still to be introduced?
Yes, so it wasn't announced in the budget yesterday, but literally it is included in their policy statements and their costings, so it is still due to be introduced from April 2023.
Okay, thank you. And I believe our final question, there might be one more. Final question, are there going to be any changes to entrepreneurs relief or business asset disposal relief, as it's so handily called now? Pippa?
Thanks, Isobel. No, we haven't been told about any changes to that in the budget yesterday, so as it stands, we still have that available.
Okay, thank you very much. We've got a question about R&D allowances and structure. Oh, R&D capital allowances and structure. Mark, may I pass this over to you to answer? Have there been any specific changes announced?
Sorry, I'm just reading the published question. Regarding the 20% RDEC rate, will this be dealt with in the first year, the same as when it's dealt with? Explain, will split over each period, or will it apply to periods starting? So it's from the 1st of April. Sorry, it's from the 1st of April. So it will be it will be split effectively. So the 20% and the same for the SME rates kicks in from the 1st of April, 2023.
I think you jumped to another question there, Mark. So
oh, did I? Sorry.
Yes, you did. I think you just covered one that was talking about when the new changes to the rates comes in. There was another question, which
okay.
I think I can answer. I'm happy to answer. Another question about capital allowances in relation to R&D. So R&D allowances on items of plant, machinery and structure, which are being used for a qualifying purpose of R&D. Note, there's been nothing announced in relation to those, so I imagine they're carrying on as they have done before. Okay, just checking, is there anything else? Sorry, I'm trying to jump around all the questions. One question, has there been any change to pension taper thresholds given the reduction of the additional rate band? And no, there was nothing announced in relation to that yesterday either. I think that might be us for questions. Okay, all right, I think we're good. So I'd just like to thank everybody for joining us today. As I said, if you've got any questions, do talk to one of your Bishop Fleming contacts. There is going to be plenty of stuff published on the website. There will be a recording of this available in a couple of days. Yeah, so thanks again.